Welcome to Discovery Watch with John Kaiser.
I'm Jim Goddard. Welcome back to the program, John.
Thanks, Jim. Glad to be back.
John, last week started off with a $2 billion cash bid for Arizona Mining and its Hermosa Taylor project at a 50% premium to the market. On Thursday, we saw a $500 million cash bid for Eldoradian and its Curragh Ragnalt gold project in Northern Ireland at a 62% premium to the market. One of our Discovery Watch juniors is Playfair Mining, which is planning a drill program on its high-grade gold target at Oxmart Mountain in Ireland. Playfair barely traded. Last week, you talked about Inzinc Mining and its West Desert project as an alternative to Arizona Mining. The stock had a small boost in trading, but the price barely budged. What does it take to turn around the junior resource sector bear market?
Jim, when I saw that takeover bid for Dalradian, which came as a complete surprise because the stock had not too long ago been languishing at around 75 cents, the first thing I thought of, what similar story would benefit from it? And so I thought, okay, Ireland. Who's in Ireland? Who's got some high-grade gold? Well, and I thought of Playfair Mining, which doesn't yet have a gold deposit, but it has a high-grade quartz vein-related target in Ireland, 100 kilometers to the southwest of the Curragh deposit, which is a 3 million ounce deposit of 15 grams per ton, for which the company completed a feasibility study that proposed to put it into production as an underground mine at 1,500 tons per day. And so I looked at the stock, and it had not moved. And even though the only connection is that they're looking for something like the Curragh deposit and is located in Ireland, one would have thought somebody might go in there and buy 10, 20, 50, 100,000 shares just to wait and see if there will be some follow-through trading. In the case of Inzinc Mining, which is a much more similar project to Hermosa Taylor of Arizona Mining, where we already have an existing resource with an economic study that's at the PEA level with additional exploration expansion potential, we did see some liquidity flow in, people buying the stock, but there was enough selling to snuff that out, and the stock is pretty much settled back into this 11-cent price range. So the answer to your question is that the consensus outlook for the resource sector space and the junior space in particular is that we are in a bear market because the global economy is headed to a downturn. Now, that is not what the rest of the world is thinking. The American economy is doing better than it ever has done in its entire history. The concern, however, is that, say, in the case of gold, which has broken down through 1,300 and is now limping along just below 1,270, threatening to plunge back down to its 1,050, 1,100 range where it was. The concern with it is that, American economy is doing so great, U.S. dollars going up, some of the policies being enacted are harmful to other global economies, which will only make them poor and the American dollar stronger, and interest rates are rising, all of which is theoretically poor for gold. But then there's also the risk that will this lead to a financial crisis? And yes, that's supposed to be good for gold, but in the interim, as we saw in 2008, gold is the one reasonably portable asset that always has a floor, and it becomes that which everybody sells if they own gold in their quest for liquidity. So we almost see gold anticipating this negative outlook. As far as sort of base metals are concerned, the sense is, we've got, zinc at $1.40, we've got copper over $3, we've got the global economy, bigger and better than it has always been. But with the threat of a global trade war hanging over the market, there is this concern that this can't last. And because the mining industry overdid it with the China super cycle and overbuilt just as a financial crisis wiped out the demand growth and ended up with everybody in the doghouse because they overpaid and overbuilt, there's this wisdom in the system right now that, well, we're not going to get fooled this time. So there is no real enthusiasm for the capital markets to go into the resource sector. And so this gloom and doom is hanging over the market. But I looked a little closer at both of these, South 32 bid for Arizona mining and the Orion Mine Finance bid for Dalradian, and I discovered something really interesting. Both of these bids have prices which assume much stronger markets than is evident in the bearish sentiment out there. In the case of South 32, the price it paid is fair value for a project at this stage. It's about the PEA that they put out back in updated in January came in at 2.1 billion Canadian, but that was the value based on like $1.05 or so zinc and a similar price for for lead. Zinc right now is at $1.40, but the company is paying 2.1 billion Canadian cash to buy out this project now. So I have I'm involved with something called the Share Collective, which is a startup that's still in beta testing. Anybody can go there and register and start using it for free to check it out. This is a site where one can put in the numbers for a mining plan and a deposit and get the after-tax net present value that is the key to valuing a company. And they have put in the PEA assumptions for Hermosa Taylor in life of mine average terms, except rather than using the base case prices, they've let it run at $1.40 zinc at the spot prices for zinc and lead. And what you get is a much higher value than 2.1 billion Canadian, but given the stage where it's at, $2.1 billion is fair value. And these mining companies, when they buy something, they have their own vision of what they think the future of the metal prices will be, assuming that the cost assumptions in these economic studies are reliable. Clearly, South 32 does not share the market's view that zinc's going to be down there at $1.10 where the base case prices are being used, which is what you might expect if the global economy is going to go back in a downturn. And similar case with the Coronat deposit of Dalradian, the price that is being paid now, the base case price was $12.50 an ounce. It's now $12.70. The price is actually higher than what would be fair value. So Orion Mine Finance is clearly thinking that the future holds a higher real gold price than what we are seeing now. So both of these bids are trend buckers. They are bucking the negative consensus outlook reflected by the market pricing. And we're seeing 50% premiums in the case of Arizona Mining and a 60% premium in the case of Dalradian. This is really important to think about. Now, neither of these bids will completely close until September. So it's not like we have an extra $2.5 billion of cash sloshing around in the market. However, the arbitrageurs are buying the stocks at a small discount from the cash bid price. So some liquidity is being created. But the chicken and the egg problem that needs to be solved for this junior bear market to turn around is not only does some of that money have to be recycled, but its willingness to come off the sideline and not just bank itself hinges on seeing a trend reversal in the market. And now everything is kind of just fading away. So this is the chicken and the egg problem that we are seeing here. We understand why everything is fading away. There are alternative short-term gambling vehicles such as cannabis and cryptocurrency, blockchain to chase into and play the greater fool spiral. But as long as the market sort of has this negative view regarding the direction of the global economy and perhaps the financial sector in general, there is a reluctance to be a hero and start buying these stocks, being a contrarian. And yet South 32 and Orion Mine Finance are clear contrarians. They are isolated. We saw something similar a month or so ago when Barrick stepped up and put $50 million into Midas Gold to get a piece of the Stibnite project, which literally needs $1,600 gold to be a no-brainer. And as is the case with many of these projects, which are sort of marginal at the metal prices that we do have, it doesn't take much of an increase in the price of gold to make these things absolute no-brainers. So I am encouraged by these two bids. We've got the dog days of summer to work our way through, but I'm now much more optimistic that come September we will see a turnaround. And with regard to the overall negativity about where the global economy is going with trade war and all that, the key date will be November 6th to see how does this play out. It could end up that Trump retains control of all the houses and can carry on with what he's doing, or it may be that the Democrats get one of the either the Senate or the House and can start blocking this. It really doesn't matter. It's the uncertainty about where this can all go, how extreme it can all go. In fact, if the Republicans retain control of everything, it actually might result in a moderation of these policies and cause people to stop worrying that everything is going to crash and burn. So I am quite pleased with these two developments, and we should all be on a lookout for similar takeouts which reveal that the big miners or groups with a lot of money are showing that the consensus negativity is wrong and are putting up money to prove it.
We'll have more with John Kaiser right after the break.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Welcome back. We're speaking with John Kaiser. John, do you have a new Discovery Watch example of a junior with a project whose value benefits from the contrarian optimistic outlook held by South 32?
One of the companies that I have been doing homework on since meeting with management at the PDAC conference in March is Osisko Metals. Osisko Metals was, of course, created by Sean Ruzin's group, Osisko Royalties, Osisko Mining. What they decided to do was create a vehicle that would be focused primarily on zinc, because they believe that the long-term real price for zinc is going to be $1.20 or better, not go back to 80, 90 cents where most of these projects do not work. And they started off with assembling some projects in Quebec that weren't particularly interesting, and then they started assembling land in the Brunswick mining camp, which was a major zinc producer from VMS deposits. This was largely operated by Noranda, and they mined the obvious targets, the big giant deposits, but then kind of abandoned it when the big deposits were gone. To find more, you're going to have to go deeper because the stratigraphy is tilted on its side. Maybe there is new geophysics today that can help tease out targets, and with some deeper drilling, you can spear them and demonstrate that the Brunswick mining camp is still alive and well and can produce a lot of zinc down the road. But then the company did another thing, is they acquired Pine Point Minerals, which had acquired the Pine Point deposit from the Tamerlane bankruptcy. Now, Pine Point was a fabulous Canadian zinc deposit in the Northwest Territory. It's this Mississippi Valley type of system where former barrier reefs, the coral and all that turn to limestone and gets rotted out, and fluids come in and create these high-grade zinc-lead deposits. And there's about 100 or so of these deposits along a 40-kilometer stretch. Cominco mined it from 1964 onwards, doing one little shallow open pit after another. They never go any deeper than 80, 100 meters. But then sometime in the 80s, they lost interest. They had discovered Red Dog. Red Dog is an absolute world-class, phenomenal zinc-lead deposit in Alaska. They had union troubles at Hay River with the operation of the Pine Point mine, and they started having water inflow problems, so they said, we don't need this grief. We're out of here. We're going to focus on putting Red Dog into production. And that was a pretty smart decision. When Peggy Whitty's Tamerlane took this on during the China super cycle, they wanted to put one of the large deposits that's a bit more removed from where all these other ones are clustered into production, use some freeze technology to deal with the water problem. But they crashed and burned, and zinc prices did not cooperate. Kerry Knoll's company, he took charge of Darnley Bay, changed its name to Pine Point Minerals. They acquired this project, and then Osisko Metals absorbed Pine Point Minerals last year. This has been a reason the stock has gone down, because there's been people looking for liquidity. What Pine Point had done was a new preliminary economic assessment, a PEA, in April of 2017, and that came in at 200 million Canadian, using the usual low, prices of 90 cents a pound lead and $1.05 per pound zinc, and that wasn't particularly interesting. IRR, however, was 35% at that rate, but it was small scale. The combined lead zinc grade was was only about just under 5%, and it really didn't look very interesting. But also in the share collective, the Pine Point PEA has been input, and instead of running it at the base case price, it's allowed to run at the current metal prices. And this project, right now, it is priced at fair value at the PEA stage, which is still only a fraction of what its value would be at if it were actually ready to go into production. That would be $323 million US, almost a $3 a share equivalent for a stock that's bumbling along at 60 cents. The company's now in a major exploration program to convert these 40-50 deposits that have been left behind into a higher level resource category. The goal is to get the average grade up to 5 to 6% instead of this sort of 3 to 4% combined that was being used before. And if they can demonstrate this, redo the PEA, hopefully be able to use higher metal prices than was used in the base case for the base case prices in the PEA, and get absorbed by somebody who wants to put this back into production. Incidentally, the Osisko Group, and this includes Bob Wares, who was also on the board of Arizona Mining, they were the group that bought into Arizona Mining in March of 2016. Osisko Royalties paid $10 million for a 1% NSR. When you run the value of that NSR in the current mining scenario that South 32 has adopted as it absorbs it, that $10 million investment, assuming that the Hermosa Taylor goes into production in 2020, it has a $48 million US value using a 10% discount rate and an $88 million US value, net present value, using a 5%. So this is an example of how doing a gutsy royalty deal can pay out. And, well, with the Osisko Metals and its Pine Point project, They are making a bet that they can stitch this all together. They are making a bet that the consensus outlook about the global economy and the future of zinc prices is wrong. And they are also making a bet that by putting geologists to work and new geophysical technology in the old Brunswick camp, that they can find deeper deposits that were not available for the previous operators in that camp to find.
We'll have more with John Kaiser right after this.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're still chatting with John Kaiser. John, Cleantech published its definitive study on feasibility last night for its nickel, cobalt, scandium Sunrise project in Australia. Why was the market reaction so negative?
I'm not sure why the market reacted negatively. It wasn't exactly a secret that the capital costs would come in higher than they were in the pre-feasibility study. The numbers are, it has a $1.4 billion U.S. NPV at 8%, which is a reasonable discount rate to use. But its internal rate of return came in at 19.1%. And I think the market doesn't like that because Cleantech had some leeway in choosing the base case prices that it used for this project. And yet they couldn't get it to 20%. Nominally, there's not much difference between 20% and 19%, but the optics really make a difference for the market. People prefer to see 20-something% IRR. The other problem is that the NPV, the after-tax NPV of $1.4 billion U.S., is lower than the $1.5 billion capex for this project. And we do know that when they finally build this thing, that the capex will be even higher. So there may be concern in the market as to whether or not this will be funded by somebody. Another concern might be that they are now using $7 nickel as the base case price, plus a $1 premium for producing the high purity nickel sulfate needed for the battery market. This project is entirely focused on the battery market, and they're using $30 a pound for cobalt. And cobalt's been as high as $42 a pound in this recent cycle. It's around $37 per pound right now. But the market's also concerned about what is the right price to use for cobalt, considering that Congo has the ability to produce a lot more than the 65% or so of world supply that it already supplies. There's also the interesting thing that Friedland's Ivanhoe Mines did a financing a few weeks ago with a Chinese state-owned entity that put $700 million into Ivanhoe for the development of the Kamoa-Kakula project, which is all copper and no cobalt. But it was also a signal that China does not have an issue with the crazy internal politics of the Congo. Katanga ended up doing a deal with Gertler, who is Kabila's best friend, but Kabila is probably on the way out. There'll be a new group of people who take charge of the Congo. They have adopted a mining law which is hostile to the, profit needs of Western countries. So China is staking out the Congo as its domain. It can operate on a government-to-government level, make sure everybody in the Congo is happy, also make sure that its security of supply needs are met, because China has made a decision. It is going all out for electrical vehicles, the lithium-ion battery, which at this point requires cobalt in the cathode. It is the preferred battery for its electrification of its car industry. 2025 is its goal to be completely electric vehicle. This project is expected to come on full stream early 2023, so it will be supplying cobalt to the Chinese market at a point where they've already pretty much have had to take care of their cobalt needs, which I suspect a good chunk of which will come from the Congo. So the market may be sort of saying, will $30 really be the price that this commands down the road? And therefore, who's going to put up money? But there is another dimension to this project which is really, really important, and which makes me very optimistic that Cleantech will be able to raise capital, and it will very likely raise it from Chinese sources. Because the Chinese can't be guaranteed that the Congo is going to work out in their favor. All kinds of stuff can go wrong there. You know, maybe Ebola turns that place into an absolute disaster where nobody wants to go there and do anything. So investing in putting up the $1.5 billion capex for Sunrise to develop the nickel cobalt sulfate output, that makes a lot of sense. And if by the time it is in production, the whole thing is a write-off, it isn't completely a write-off, because they are going to be recovering up to 80 or 90, around 90 tons of scandium oxide from the ore that they will be processing. And the refining capacity, although it's 90 tons per annum, they will only be producing 10 tons of scandium oxide per year. The flow sheet will be precipitating out the scandium oxide as a hydroxide, and they will be stockpiling it for the future. Now, this is actually a very positive development for Scandium International and its Ningin project, because this gives potential off-takers assurance that down the road, if we want more scandium than we're able to get from Ningin, or if there are problems at Ningin, here's this company which is stockpiling all this scandium material as a byproduct that we'll be able to turn to and continue making our aluminum scandium-based alloy components out of this. But even more importantly, the Sunrise deposit has a scandium-enriched component which has much lower cobalt and nickel, and they are not touching that. They are right now getting the lower 50 to 70 ppm scandium out of the nickel cobalt enriched ore. But if for whatever reason when they finally build this, it doesn't quite work as well with the nickel cobalt recovery, or the cobalt price is a lot lower, so it doesn't make sense to focus on that, or the company or whoever ends up owning Cleantech will have the ability to use that infrastructure and start feeding the scandium-enriched ore, and that runs 300 to 600 ppm, 5 to 10 times higher than the grade of the ore that's headed for the nickel cobalt processing portion of the flow sheet, which in fact is the same flow sheet used to recover the scandium. So as a default for the Chinese is, down the road, if this thing doesn't work as a nickel cobalt mine, it could work as a giant scandium mine producing 200 tons plus per year. And by that point, Scandium International will likely have developed its Ningin deposit, probably scaled up its output of scandium oxide. It'll have developed the offtake markets, which based on a diagram that they recently published showing all the potential offtake markets, could easily achieve 1,000 tons per year. So even Sunrise and the Sunrise project and the Ningin project combined will not fulfill the ultimate demand that is possible. And Cleantech has clearly ceded the field to Scandium International to develop. Its focus now is the race to get this nickel cobalt plant into production to be able to supply the battery metals market. And the fact that they are not really that interested in finding an offtake market for the scandium is that their focus for now is in this relationships they have with Chinalco and Airbus to develop new applications or new alloys, aluminum alloys involving scandium, which is interesting because there are plenty of applications already for existing alloy configurations. So what they're really talking about is doing homework on coming up with future demand that is even bigger than what everybody can already see coming into this market. So in essence, they are ceding the field to Scandium International to develop, to get it going, while they focus on the nickel cobalt. And the funding for the nickel cobalt will likely come from Chinese sources who see the scandium as a potentially more valuable consolation prize in case the nickel cobalt scenario does not play out as a profitable operation.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Discovery Watch is a production of How Street Media Incorporated.